time to throw on the Raiders hat because talking about fixed income yields, interest rates in the DXY is anything but fun. I want to take some time to make this quick video to talk about the difference between the 10-year United States Treasury yield and yields in general versus the United States dollar index, also known as DXY. This is the value of the USD currency versus a basket of other currencies globally, 6 in total. The reason I want to talk about this is because the divergence happening between the two. Now, usually when the federal funds rate is raised higher or lower by Powell and the central bank, that affects yields as well as the United States dollar. And I will get into those reasons specifically why. But first, let's take a second to talk about the United States Treasury yield and what it actually is and how the United States dollar works and how they work against another or work together with one another and move based off economic conditions, etc. Now, simply put, the 10-year Treasury bond yield is the expected annualized returns that an investor is expected to gain by holding this government debt for that maturity period. So whether it's 10 years, 2 years, 5, 20, or 30 for pension funds and asset managers, that is how much you are going to make every single year guaranteed by the United States government for holding that bond. Now, as mentioned before, the United States dollar index, known as DXY, is the United States currency based off another basket of currencies, which are some of the largest in the world, 6 in total. These are the Canadian dollar, euro, pound, yen, Swiss franc, and Swedish krona. Just remember, DXY is going to move higher or lower relative to the economic strength of the United States dollar versus the economic strength in the economies of these other 6 countries' currencies. Okay, so if the U.S. has low inflation and we have high demand for our bonds, our risk assets like equities, our goods and services, imports and exports, then the value of DXY is going to move higher. But if Europe and the Swiss and Japan have higher economic certainty and their economies are well off, then the value of DXY is going to decline. As you can see right now, it's at 99, okay? So finally, before we get into the divergence and what is actually going on, we're going to talk really quick about what influences both the 10-year and the value of the dollar. So listing them out, you have supply and demand, you have interest rate hikes that are currently present or are expected to happen in the future because of rising inflation. You have inflation, which is happening because there is too much money that has been printed on a monetary level and on a fiscal level, too much debt that has been issued since COVID. Economic growth expectations, how our corporations are doing, how much goods and services and supply we are exporting to other countries, and also risk sentiment. So what is going on right now in the country? Is there war? Is there a tight monetary policy? Are politicians coming up with new policies that are constricting corporate growth? Do we have an election on the horizon? Things like that. Also, more tilted towards the DXY and the United States dollar is the United States a safe haven investment vehicle for global institutional investors, okay? Do they want to take their money and maybe take out loans on their own currency, invest that into the United States dollar, raising the demand for the dollar, and invest in United States assets like U.S. Treasuries or U.S. equities? All these things together can influence yields and the value of the dollar, and it is very, very important that these usually stay in line with one another. So let's go into now and talk about how things usually work. Now, the way things work is every single time Powell and the Fed changes the federal funds rate, they're also changing the interest rate payments on your credit card bills or on mortgage rates, auto loans, loans from a bank, and United States Treasury yields. Okay. Now, these fixed income investments serve as a hedge to risk assets like equities, like crypto, like the real estate market, which you guys have seen in the last 3 or 4 years since COVID and Powell's 11 rate hike campaign, what it has done to the housing market, messing with supply and demand, making mortgage rates up to 8%, right? This is a way to invest in a vehicle that will give you a fixed income yield over a specific period of time. And while that may not mean so much to retail investors like you and myself, pension funds and asset managers that have $100 billion, $50 billion assets under management, it really matters if they can retain and receive a 5% yield just by holding a 30-year United States Treasury bond. Now, what I have pulled up on my screen here is the 10-year United States Treasury yield minus the 2-year. This is called your yield curve. And this is one of the most misunderstood things in all finance. Trust me, it will take you some time to wrap your mind around this, but to dumb it down for you, remember when the Fed changes the federal funds rate, he is changing the yields on the near end of the curve, not the long end, okay? The long end will adjust depending on how the 2 years change. The long end will also adjust based on inflation expectations and interest rate hike expectations in the future, okay? And remember, guys, bonds 101, like when quantitative easing was happening with the Fed, when there is a higher demand for bonds, the prices of those bonds rise. Conversely, the yields of those bonds decline. And every single time they issue new bonds at a Treasury auction with new higher yields, those older bonds adjust in price. So when you're looking at something like Bank of America and their $130 billion in unrealized losses, that's because their old bonds that they bought multiple years back are lowering and declining in price because the new bonds have higher yields, and you have, hedge fund managers like Bill Ackman and Stanley Druckenmiller shorting the bond market into the absolute dirt. But for the yield curve, and this is how things work, institutions are consistently buying the near end of the curve, okay? So what does that mean? That means they're buying the 2-year, the 1 year, the 6 month, the 1 month. That pushes the demand for these bonds on the near end of the curve up, so their prices rise. Conversely, their yields fall. This is called bull steepening. You're going to see the yield curve move upward in a trajectory like this, and I will show you 1 second on the chart after I explain this. But on the long end of the curve, which is the 10-year, the 20-year, the 30-year, you're going to see those bond prices decline and those yields rise. Why are those yields rising? Well, one, there is not high demand for the longer end of the curve, so those bond prices are going down. And two, in a normal growing economic market, inflation expectations are rising consistently, not out of control, but rising consistently. So institutions demand higher yields on the longer end of the curve to hedge for this inflation heightened expectation, okay? So this is normal. Bull steepening. Yield curve is normal. Institutional hedging activity is going on a day-to-day basis. When the yield curve inverts, you now have impending recession fears. The yield curve will only invert for two reasons: rampant inflation expectations or interest rate hikes that are going to come in an abundance from the central bank and the Fed. Okay, so when the Fed started hiking rates in 2022, I'll give you an example. That's when the yield curve inverted at the top of quantitative easing because they knew inflation was too high. CPI had inflation at something like 9.1%, and Powell went on his interest rate hiking campaign, which was the most aggressive in history. When this happened, firms said, we're going to stop buying the near end of the curve with our normal hedging activities, and we're going to buy the further end of the curve, which is the 10-year, the 20-year, the 30-year. So what does that mean? The price and demand of those bonds is rising, okay? But conversely, their yields are falling. And then on the opposite end, on the near end, nobody is buying the 2-year anymore. So their prices are declining, but their yields are rising, and it inverts, okay? Any single time you see the yield curve invert, and just make it very simple, yield curve inverts, recession and interest rate hike expectations are incoming. And when that happens, that basically means that the institutions aren't trusting that the Fed is going to cut rates or lower rates to allow corporate expansion to continue. Remember, with equities, what drives the S&P higher is corporate expansion and corporate earnings. If interest rates are high, these corporations, Tesla, Facebook, Apple, etc., cannot take out a $150 million loan from JP Morgan at a low rate and expand their corporations, right? Grow their labor market, expand corporate earnings, which would drive the S&P higher. So what they do is start hedging with further dated bonds, okay? Anytime you see the yield curve invert, that means institutions are hedging for further term interest rate hikes and further term heightened inflation expectations. This is bad, but it's not immediately bad for equities. It takes some time. When the yield curve uninverts, that's when things get real, because that means they're shifting their investments from the longer dated end of the curve to the near end of the curve to hedge for impending doom within a 2-year, 1 year, 6 month span. And that is how the yield curve works. So let's go back to the chart and let me show you some examples so you guys can see. Okay, normal hedging activity, inverse. Normal hedging activity, inverse. Anytime you see the yield curve go from this coasting around this line, okay, to invert here, 2019, where the repo market had a scare and rates rose because of lack of liquidity. And then you had 2020 with the COVID pandemic drop. And then as we got into the top of quantitative easing, which ended in March of 2022, and Powell started his interest rate hiking campaign, which was the most aggressive in history again, that's when the curve inverted for the longest period we have ever seen in the history of the stock market. It was roughly 786 days, still the craziest thing you'll ever see. So what that basically means is that institutions were so worried that inflation was going to be rising and that interest rates were going to be continuing and constricting corporate earnings, which would have decimated the stock market and was supposed to, that they started loading further maturities 10 years and out to aggressively hedge their equity portfolios for the longest period in stock market history. This chart by itself screams recession incoming. Because if the most powerful institutions, both domestically and globally in the world, are loading United States treasuries at this level of volume for this long period of time, doesn't tell you that something in our underlying economy is completely broken, nothing will. This chart shows impending doom is happening. It will happen in the next 12 months. Okay, so finally, why the divergence between the 10-year, which is moving higher, and DXY, the value of the dollar, which is moving lower, okay? Usually, when the federal funds rate is raised, which it's currently raised at 4.25%, and Powell has been holding on to that for almost a year now, pause with no rate cuts in sight, that keeps yields higher across the board. Not only the 2-year, but the 5-year, the 10-year, 20, 30, etc. Think of it like this. If the Fed is raising interest rates, it's not only going to raise rates for things like credit cards, mortgages, and auto loans, it's also going to raise the interest payment that is paid out on any maturity term bond. Additionally, if interest rates are being raised by the Fed and yields are moving higher, then that also means that you as retail or an institution have a higher interest rate payment on your debt. So you're going to have to allocate your current profits and earnings to more of your debt to pay that off. This strengthens the DXY and the value of the dollar in turn. So what is up with this divergence? How can the Fed be keeping interest rates high and yields subsequently higher with payments being paid off on more debt, but the value of the dollar is dropping? Well, it's a couple of things, like rampant inflation that is not coming down, the fact that no cuts are really in sight because they cannot get inflation to that 2% target. While it's declining on the monthly, CPI, PPI, and PCE, year on year, inflation is staying sticky. We're more like in a period of stagflation right now, which is bad for the economy. You couple this with Trump's newly added tariffs on China and other various countries that he is being very aggressive about, on top of the fact that the United States debt is growing at a rate of roughly $500 billion to $1 trillion per month, it doesn't paint a pretty picture for institutions that want to invest their hard-earned dollars in United States equities or United States treasuries. And that is why you are seeing such a large divergence between the 10-year or further dated 20 or 30 treasury yields and the value of the United States dollar index, okay? Very simply put, institutions right now do not trust America and what we are doing with our economy. They are demanding higher yields on the longer dated end of the curve to prepare for interest rate hikes or rampant inflation coming in the near future. Once Trump's tariffs are managed, finalized, and completely under control, we will be looking at a different economy in total. Yields will adjust and fix themselves as long as they can get the United States debt issue under some form of control. Now, it doesn't really look like that with Trump proposing the new, big, beautiful bill that is looking to pass through Congress right now, which would be an additional $5 trillion of spending and adding a fiscal debt. This is in no way, shape, or form helping anything that Biden did during his 4-year term when they were issuing debt like drunken sailors, okay? $12 trillion were issued in debt since the COVID bottom. 4.7 trillion in monetary stimulus was printed. So if Trump's going to continue to go in that same direction, we are in a lot of trouble, and you can expect the value of the dollar to continue to decrease and yields to rise as institutions prepare for a recession.